Okay, Garmin just released their Q3 2025 results, and the headlines look great, right? Record revenue, record operating income,
Sounds like a winner.
but the stock, it dropped, fell over 10% the day they announced.
And that's the core puzzle we're tackling today. How does a company report, objectively great numbers and still get punished by the market?
Right, so our mission here is to dig into that fine print. What was the street really expecting? What did Garmin maybe not quite deliver in their outlook?
Let's get straight into it. You look at those numbers and it's confusing.
It is. So what were those top-line figures, the record ones?
Okay, so consolidated revenue, it hit about $1.77 billion for the third quarter. That's a record for Q3, up a solid 12% year over year.
12% is strong.
It is. And operating income also set a record, $457 million, up 4%. Pro Forma EPS, earnings per share, that came in flat compared to last year at 1.99 cents.
Okay, see, on their own, those numbers look pretty good. A grade, almost. But the market doesn't operate in a vacuum, does it? It's all about those consensus models. And that $1.77 billion in revenue, that seems to be the sticking point. Analysts were modeling, what, $1.78 billion?
That's right. A small miss, about $10 million.
And when you combine that slight miss with the implied outlook for Q4 sales, well, that looked like it fell short of the $2.03 billion estimate people were expecting.
And that's enough for the market to call the whole thing mildly disappointing.
It's that gap, isn't it, between just meeting expectations, maybe slightly missing, versus beating them. For a growth stock like Garmin, that feels like a letdown to investors.
It really can. But what's really interesting here, I think, is that despite the market getting grumpy, the company actually raised its full-year guidance.
Hang on, they raised guidance. After that reaction, that usually signals confidence. What did they adjust?
Right. So they kept the full-year revenue target the same, $7.1 billion. But they bumped up the full-year pro forma EPS guidance to $8.15.
Okay, that's up 0.15 cents from before. That's not insignificant.
Not at all. And they also nudged up the full-year operating margin expectations slightly to 25.2% from 24.8%.
So there's the paradox. Clear as day. Record quarter, higher profit guidance for the year, but a 10% stock plunge. This really tells you it wasn't just about the total amount of money. It was how they made it, where the growth came from, and maybe some pressure points in segments the market watches really closely.
That's exactly it. The quality, the mix of that revenue mattered more than the sheer number this time. To understand why, we really need to break it down segment by segment. See the winners and, well, the losers.
Okay, let's do that. Let's start with the good stuff.
Yeah.
The CEO talked about the strength of our unique, diversified business model and pointed to double-digit growth in 3 segments. The big winner this quarter was fitness.
Fitness was absolutely the powerhouse. We're talking $601 million in revenue. That's up a staggering 30% year over year.
30%? Wow. What drove that?
It wasn't just one thing. It was strong demand pretty much across the board for their advanced wearables. Think the new Edge 550 and 850 cycling computers, the Bounce 2 smartwatch for kids, and the high-end Venue 4.
And this is where Garmin gets really interesting, I think. They're not just selling gadgets. They're embedding themselves in, like, medical research, too, right?
Exactly. They announced a collaboration with King's College London. Garmin is now the exclusive smartwatch provider for a research program called Embrace, which is studying maternal health.
That's huge. It says a lot about the trust in their device accuracy, doesn't it? Getting involved in actual medical research.
It's a fantastic strategic play. It builds that institutional trust. And, that kind of validation probably gave them the confidence to massively raise the full-year growth estimate for fitness. They bumped it up from 25% growth expected for the year to 29%.
That's a big jump. Okay, investors have got to love that part of the story. What was the second growth pillar? Marine?
Marine also had a very strong quarter. Revenue was up 20% to $267 million.
Also double digits. Nice.
Yeah, and this segment keeps growing because they keep innovating in specialized gear. They launched the Force Current System for kayaks, which sounds niche but is important there, and expanded the Force Kraken trolling motor line. They even have a huge 110-inch drive shaft model now.
They really own that space.
Yeah.
Weren't they named Manufacturer of the Year again by the NMEA?
For the 11th year in a row.
11 years. You don't do that by accident.
Definitely not. And that strength led them to raise the full-year growth estimate for Marine 2, doubling it from 5% to 10%.
Okay, good news keeps coming. What about aviation?
Aviation, consistent as ever, up 18% to $240 million. Growth came from both OEM supplying manufacturers and the aftermarket, upgrades.
What was the highlight there?
A big one was getting their Autoland and Auto Throttle systems certified for retrofit in some Beechcraft King Air 350s, so older planes can get these cutting-edge safety features installed.
That's impressive tech.
Yeah.
Okay, so fitness soaring, marine strong, aviation growing steadily, all with raised guidance. How did the stock still manage to drop 10%?
Now we get to the segments that pulled things down. And the big one, the real disappointment for the market, was outdoor.
Outdoor. That's usually a strong segment for them, high margin too. What happened?
Revenue actually went down 5% to $498 million. And the company basically put it down to difficult comparisons.
The dreaded tough comps.
Exactly that. They were up against the anniversary of last year's really big product launches, especially the, quote, highly successful Phoenix 8 launch.
Okay, but I have to ask. In consumer tech, especially wearables, isn't that kind of expected? You need constant innovation. Saying it's a tough comparison sounds a bit like we were too good last year. That lack of continued acceleration can definitely spook investors, right?
I think that's exactly how the market read it. And that skepticism showed up clearly in the guidance change. They slashed the full-year revenue growth estimate for outdoor, slashed it from plus 10% all the way down to just plus 3%.
Ouch. From 10 down to 3% growth expected for the year. That signals they see their weakness continuing into the holiday quarter. That must have been a major factor in the stock drop.
A massive factor, I'd say, even though they are still innovating in outdoor.
Right, what did they announce to sort of signal they're still pushing?
Well, they launched the new Phoenix 8 Pro series. That's significant because it adds in-reach satellite and cellular connectivity. And maybe the most exciting bit, there's a version with a high-resolution micro-LED display.
Micro-LED. That's a serious screen upgrade. Cutting-edge stuff.
Definitely. And showing they're still looking for those unique niches, they also launched something called the Blaze Equine Wellness System for tracking horse health.
Horse wellness. See, that's Garmin finding those specific, probably high-margin areas. But even micro-LEDs and horse trackers couldn't offset the broader outdoor slowdown perception.
Not in the market's eyes, no. And the final piece of negative news came from the smallest segment, Auto OEM. It wasn't just slow, it actually lost money.
Auto OEM lost money. How? Revenue was only down slightly, wasn't it?
Revenue was down 2%, to $165 million. Partially due to some older programs ending, though they did hit a milestone shipping the 3 millionth BMW domain controller. But the shock was the operating loss of $17 million for the quarter.
A $17 million loss on $165 million revenue. Why this sudden dive into the red?
It came down to warranty costs. They had an unexpected increase in accrued warranty costs linked to products sold in previous periods. Basically, they had to set aside more money than planned for potential future repairs on older stuff.
Oof. A surprise warranty hit. That goes straight to the bottom line and definitely wouldn't help investor confidence.
Not at all. So that paints the picture. Really strong growth in 3 core areas, but overshadowed by the outdoor guidance cut and that unexpected loss in Auto OEM.
Okay, that makes sense. Now let's zoom out a bit to the overall financials. There were some pressures there too, weren't there? Margins and expenses?
Yes, the gross margin tightened a bit. It dropped about 90 basis points, almost 1 percentage point, down to 59.1% compared to last year.
Why the squeeze?
2 main things. Higher costs for components and materials, inflation still lingering, and the strengthening Taiwan dollar against the US dollar. Since a lot of manufacturing is there, that makes costs higher when translated back to dollars.
Okay, so cost inflation and currency headwinds hitting margins. That's tough. And they were spending more too, right? Investing heavily.
Absolutely. Total operating expenses jumped 15% year over year. That was driven mostly by hiring people. R&D costs up 15%, selling, general, and admin costs up 14%. They're clearly hiring engineers, sales staff, investing for future growth, betting on innovation.
Which is good long term, but adds costs now. And then, didn't taxes also take a bigger bite, like a surprise from Uncle Sam?
That was the final sort of non-segment hit. The effective tax rate went up quite a bit to 21.2%. It was only 17.9% the year before.
Why did it jump?
New U.S. tax legislation passed during the quarter. It apparently limited some R&D tax deductions and credits they were expecting to get. It was bad timing, really.
Okay, so if you're an investor, you're seeing margin pressure from costs and currency, higher spending on hiring, and a higher tax bill eating into profits. Even with the raised EPS guidance, that's kind of a triple whammy of negative financial trends in the short term.
which helps explain why the market reacted the way it did, focusing on those immediate pressures. But, underneath all that, their financial health is still really strong.
How strong?
They ended the quarter with about $3.9 billion in cash and marketable securities. That's a huge cushion. And their free cash flow generation was impressive, $425 million in Q3 alone. That's way up, like $206 million more than the same quarter last year. They're minting cash.
And what about inventory? Sometimes a big buildup can be a worry, signaling slowing demand.
Inventory did increase. It's up near $1.9 billion, but management was very clear this was intentional.
Intentional. Wow.
2 reasons. 1, to make sure they have enough stock for the big Q4 holiday season. 2, and this is key, to mitigate potential impacts from any future increases in tariffs. They're building a buffer against supply chain or trade disruptions. They also said channel inventory, what's sitting with retailers, remains very healthy and lean.
So a proactive move, not a sign of trouble. Okay, let's try and pull this all together for you, the listener. What this deep dive really uncovered is a company with, frankly, incredible strength in key areas. Fitness, marine, aviation, they are firing on all cylinders.
Absolutely flying. But the market this quarter chose to focus on the weaker spots and those financial surprises.
Right. That sharp cut to the outdoor guidance was a big narrative breaker. It suggested that repeating huge growth after a blockbuster product launch is really, really hard. That, plus the unexpected auto OEM loss, plus the higher tax rate, it created enough doubt to overshadow the good news and trigger that sell-off.
Exactly. But despite all that short-term noise, the CEO did share one crucial insight about the long-term health of Garmin's ecosystem.
What was that?
He mentioned that the majority of people coming to the Garmin platform are actually new users.
So they're not just relying on existing customers upgrading, they're still bringing new people in.
That's vital. It suggests they're still expanding their reach, finding new customers, which should ease some of those longer-term fears about hitting a ceiling.
That's a key point for the long view. Okay, so here's the final thought we want to leave you with. We saw the market react very strongly to sequential comparisons and near-term guidance adjustments. But if you step back and look at the innovation, Garmin is pushing boundaries. Think about integrating that high-res micro-LED display into the Fenix 8 Pro, or creating entirely new markets like equine wellness or advanced aircraft safety systems.
Real deep tech stuff often.
Exactly. So the question for you is, does that deep commitment to long-term diversification and genuine complex product innovation ultimately justify maybe looking past these temporary bumps caused by tough year-over-year comparisons and short-term financial pressures? Something to think about.